Now, before you go accusing me of being subjective, I might add that what I'm trying to do here is illustrate a simple comparison. If we just look at what the volume is doing, we can very easily compare when a particular bar has a lot of activity, meaning an extreme of activity, if it's high activity, average activity, or just low activity. Now, if you remember when I started this, I made the example of Napoleon Hill and accurate thinking. So why is it important that we understand what the comparison is? Well, the comparison is important because we need to have some form of benchmark to gauge when the smart money is coming into the marketplace. Now, that leads me right into another piece of this theory. You see, part of my theory, which has been gleaned over the years from a variety of sources, tells me that the smart money, or the professional money, gets in on the turns. Now, I know that may sound a bit almost stupid in its simplicity, but let me tell you why I say that. It's simply a function of market mechanics. You remember the example I put up on the screen earlier of the market maker and the order flow? Let's take a look at that again. If we were looking at the order flow coming into the marketplace, and as a market maker, we saw that there was average trading going on down here, but then all of a sudden we saw an influx of orders coming in up here. What if they were billions and billions of dollars looking to buy the market we were making in up here? What would that mean? Well, that would mean that if we're selling to these people at these higher prices, unless we have first purchased down here, we could stand a chance of losing a lot of money. Now, as a market maker, what we would then have the impulse to do is to accumulate or buy as much as we could at lower prices, because we are not willing to have to sell up here without first making some money. Now, hopefully that makes sense to you, simply because that's what you're trying to do all day long. Aren't you trying to buy low and sell high, or sell high and buy low? You see, in the introduction, I made the point that the market makers really are trying to make money first. So if these market makers see that there's a large amount of buy orders coming into the market ahead of time, they're going to do as much as they can to accumulate a position down here. Now, there are a variety of ways that they can do this. The first and most common way that they do this is to move the market down. Simply put, they mark the market down. Now, how can they get away with that? Well, if there isn't enough volume in the market, then they can move the market pretty much wherever they want. Why? Well, because the market maker is taking on the risk for him or herself. You see, there's nothing illegal about a market maker moving the market down. Simply put, because that market maker is taking on the added risk of accumulating a position. And if he's willing to take on the risk, then it's well within his rights to accumulate a position in this area, or even manipulate the market down. They do this in a variety of ways, and they are most common around areas of news events or just low volume in the market. So the market maker will manipulate the market to a price where he or she can accumulate a position. Even if they can do this on lower volume,